Geopolitical red lines do not exist anymore. Iranian state media officially confirms Supreme Leader Ali Khamenei and former President Mahmoud Ahmadinejad were killed in coordinated strikes. This is not a speculative geopolitical theory. This is the erasure of a state's sovereign command structure overnight. The response was immediate and absolute. Iran launched 165 ballistic missiles, 2 cruise missiles, and 541 drones. This is not a proportionate signaling exercise. It is a violent escalation, fundamentally severing the global risk architecture. The mainstream media will tell you to wait for Western futures to open to understand the market impact. The informed minority knows the repricing already happened. State-level assassinations triggered an immediate, violent repricing of necessity assets in physical and dark markets while Western exchanges slept. The separation between physical reality and paper derivatives is absolute. Paper is a promise. Physical is possession. When missiles cross borders, promises become worthless. Look at the actual metal. Look at the markets that cannot be paused by circuit breakers or managed by institutional algorithms. The dark market touched $6,000 per ounce for gold. That is not a glitch in a pricing feed. That is not retail sentiment. That is the exact premium capital is willing to pay to secure physical monetary settlement outside the traditional banking system. Silver is screaming the exact same signal, but with industrial violence. China's Shenzhen physical silver buyback price premium shot up almost $20 per troy ounce equivalent, pushing the buyback price north of $120 per ounce. Distributors are refusing to part with physical inventory. They are not waiting for a COMEX paper opening print to tell them what their metal is worth. They are reacting to an absolute supply panic. The paper price on your screen is an illusion maintained by sleeping exchanges. The physical reality is $120 silver. Momentum chasers are waiting to see what the ETFs do on Monday morning. The ones who verify the data understand that physical markets have already front-run the panic. When sovereign leaders are eliminated and hundreds of ballistic projectiles are launched, capital abandons paper derivatives immediately. It flees to assets with zero counterparty risk. The $6,000 dark market gold print and the $120 Shenzhen silver buyback are not isolated anomalies. They are the true price of the assets when the geopolitical framework burns. Western paper markets are mathematically forced to reconcile with this physical reality. The divergence cannot hold. Mainstream commentators are telling you to sit on your hands and wait for the Sunday evening futures open. They claim that is when actual price discovery happens. That is a fundamental misunderstanding of how modern liquidity functions. They are trapped in a legacy worldview where markets neatly turn off on Friday at 5 p.m. Price discovery did not pause. It simply migrated to the rails that never close. This is strictly educational, not a signal, not advice. Look at the tape. PAXG is tokenized physical gold trading on crypto rails. It operates continuously. It does not ask for an exchange's permission to reprice when ballistic missiles cross borders. The silver tape is even more violent. The divergence is absolute. IG weekend spot silver is trading near $100. Hyperliquid is showing 96. Those are the synthetic and digital rails, pricing in the shock. Now look at the physical exchanges. Shanghai spot is sitting at 105. Shanghai futures are printing 108. Western spot closed Friday at exactly 93. Do the math. That establishes a massive $27 premium in China physical markets over Western paper. These are not random numbers or retail noise. These are physical-backed crypto markets, showing you undeniable aggressive price discovery while COMEX sleeps. Weekend crypto and physical trading rails provide the exact roadmap for Western paper futures gaps on the open. Arbitrage mathematically forces a resolution between these isolated systems. You cannot have physical metal clearing at massive premiums in Asia while paper trades at a steep discount in New York and London. If Western futures do not gap up violently to match this reality, the arbitrage becomes impossible to ignore. It is a mathematical guarantee. Well-capitalized institutions will aggressively buy the suppressed Western paper, demand immediate physical delivery, and instantly sell it into the Asian premium. The vault train accelerates instantly. This is the required roadmap. When the informed minority looks at a $27 premium in Shenzhen and Shanghai, they do not see a temporary anomaly. They see a structural fracture that paper markets are mathematically forced to close. Momentum chasers will stare at the massive gap on the open, panic, and call it manipulation. The ones who verify the data know the gap is just Western paper desperately trying to catch up to the terrifying reality that traded all weekend. Zoom out. Do not mistake the trigger for the powder keg. The mainstream financial press will blame this entire price dislocation on the missiles. They are wrong. Military escalation is merely the catalyst igniting existing mathematical deficits. The structural fracture was already there. The physical market is not bending. It is breaking. Look at the raw trajectory before the first drone even launched. Structural metals deficits show 10 consecutive monthly green closes on silver. 10 months? That is not a speculative retail rally. That is a systemic, multi-quarter physical accumulation phase. Gold just printed its 7th straight record. The paper pricing mechanisms were already buckling under the weight of reality. The geopolitics simply stripped away the remaining illusion. Industrial demand has permanently altered the consumption baseline. We are not talking about jewelry. We are talking about absolute technological necessity. Solar infrastructure, electric vehicles, AI, data centers, 5G networks, military defense, and nuclear applications all demand physical silver. These sectors do not negotiate on price when they need material to complete billion-dollar infrastructure projects. They buy at the market. Meanwhile, global mine supply cannot keep pace. The extraction math is broken. You cannot print a new silver mine. And you cannot algorithmically generate a new Tier 1 deposit. The deficit is not temporary. It is a compounding, multi-year structural failure of supply. Central banks know this. They do not read Western financial blogs. They read sovereign balance sheets. Central banks are buying gold at record rates. They are mathematically front-running the exact geopolitical collapse we are watching unfold today. They are trading paper reserves for physical possession because they understand that in state-level conflict, counterparty risk is fatal. Now look at the plumbing of the system. This is the data the momentum chasers ignore. Silver lease rates spiked 6 days straight before the weekend. 6 consecutive days of accelerating stress. It is the cost of borrowing physical metal in London. When lease rates spike, it means the interdolar lending market is freezing. The institutions that normally lend physical metal to paper over the deficits are refusing to let go of their inventory. They know the vaults are emptying. When nobody wants to lend, the cost to borrow skyrockets. It is a direct, undeniable metric of physical scarcity. That spike was the alarm bell ringing inside the banking system before the kinetic war even escalated. The dam is cracking in real time. China's Dasheng Bank just issued an unprecedented notice. They stated explicitly that if a price deviation leads to the depletion of accumulated gold liquidity, trading will be closed. Read that carefully. That is not a technical warning. That is a major Chinese financial institution openly admitting they will halt trading to protect their physical stockpile. A huge amount of yuan savings are waiting for the market open on Monday. Dasheng Bank knows the capital flight into physical metal will be violent, overwhelming, and absolute. They understand that when panic hits, paper wealth evaporates, and only physical ounces matter. If the price deviates too aggressively, the arbitrageurs and the terrified public will strip the bank bare. They are literally preparing to pull the plug to stop the vault drain. They are openly telling you, we will not let you take the metal. When a bank tells you they will shut down trading to prevent the depletion of physical liquidity, you are not looking at a functioning market. You are looking at a system entering a terminal physical squeeze. The paper claims vastly exceed the physical reality, and the institutions holding the metal are locking the doors. Verify this yourself. The reports are public. Check the Dasheng Bank notice. Pull the silver lease rate charts. Look at the 10 consecutive green monthly closes. The data is screaming. The geopolitical shock simply forced the world to finally look at the math. The mainstream media thinks this is a conventional naval war. It is not. State actors abandon kinetic ships sinking for asymmetric economic warfare. You cannot protect every crane, every terminal, and every storage tank with carrier groups. They are not trying to sink individual ships. They are igniting infrastructure that cannot be targeting. Undefendable energy infrastructure and insurance rails functionally freezes the global supply chain. You cannot print energy. Look at the Strait of Hormuz. Roughly 20% of global seaborne oil trade flows through this single maritime artery. It is effectively closing. The waterway is not technically shut by a blockade. It is functionally frozen through the insurance markets. Ships traveling through Hormuz must purchase war risk insurance to protect shipping companies from attack costs. If insurers refuse coverage, the ships stop sailing. The oil flows stop, even if the water remains open. The repricing of that risk is mathematical and immediate. Insurance costs for a $100 million oil tanker just jumped from $250,000 to $375,000 per single voyage. The financial friction is becoming terminal. Maersk suspended all Strait of Hormuz transits. Right now, 150 tankers have dropped anchor in open waters. They are refusing to move. They are sitting idle off the coasts of major Persian Gulf oil producers. That instantly freezes 20 million barrels per day of oil. It blocks 100% of Qatar's world-leading LNG exports. This is a violent, negative supply shock. But the strategy goes far beyond the strait. This is a calculated maritime assault, targeting key ports across the Gulf and beyond. They hit Duqm in Oman. That port was specifically built to bypass the risks of Hormuz. They struck Jebel Ali in Dubai, crippling the known oil economy with drone hits. Jebel Ali handles 60% of all UAE imports. They attacked Mina Selman in Bahrain, the home of the U.S. Fifth Fleet. That exposes the military-commercial nexus. They hit Haifa in Israel, a critical node managing vital energy imports. Iran is demonstrating a brutal new doctrine. You can sink ships, but igniting ports wins the economic war. Ports are the real battleground. Patriot missile batteries cannot protect Jebel Ali's cranes from drone swarms. Every Gulf exporter feels the premium repricing the global tanker fleet overnight. The importers take the biggest hit. Japan relies on 75% of its oil imports via the strait. Japanese tankers are already turning back. South Korea sources 60% of its crude through Hormuz. India sources 50% of its crude. Imports roughly 2.6 million barrels per day from Gulf states, alongside 60% of its natural gas and LNG. When this energy stops, fuel prices skyrocket. The rupee comes under massive pressure. GDP growth is hit directly and violently. China absorbs the blow better through Russian pipeline diversification, but still feels massive price pain. This is textbook asymmetric warfare. This is economic warfare, meeting energy warfare. The global energy supply chain is held hostage by uninsurable risk. Capital makes a deliberate, quiet judgment about where real value resides. It rotates instantly out of paper promises and into hard, physical necessities. The momentum chasers think the Federal Reserve controls inflation. The Fed cannot drill oil. The Fed cannot sail a tanker through a drone swarm. When 20 million barrels per day of oil and 100% of Qatar's LNG exports are erased from the global board, the inflationary wave that follows will break every central bank model. This is not a policy error. It is a kinetic supply erasure. Brent oil prices are already trading up 8 to 10%, around $80 per barrel. The weekend prices are holding those gains, not giving them back. The leverage in the system makes this fatal. Every derivative contract, every consumer good, every industrial process relies on cheap, uninterrupted energy flowing through these exact maritime choke points. When insurance costs spike from $250,000 to $375,000 per voyage, that cost is passed down the entire global supply chain. It acts as a massive, unavoidable tax on global trade. But when the insurers refuse to underwrite the voyage at any price, trade simply dies. 150 tankers dropping anchor is not a traffic jam. It is the cardiovascular system of the global economy, experiencing cardiac arrest. Now the honest case for caution, because balance is what separates analysis from promotion. Survival requires attacking the thesis. The informed minority does not blindly buy the panic. They calculate the counterstrike. Look at the weekend pricing. Weekend premiums dictate direction, but they distort scale. They capture the immediate directional trend of the shock, but they tend to overstate the actual gap. These are thin, illiquid environments, operating without the massive volume of Western institutional hours. When the CME turns the machines back on, futures can gap violently higher and then immediately fill. A gap and fill is a mechanical reality of market structure when trap liquidity finally finds a release valve. Do not confuse a weekend crypto proxy for Monday's final settlement. The energy blockade is devastating, but it is a financial construct. The Strait of Hormuz could stabilize if insurance recalculates. The freeze is driven by underwriters, not kinetic barricades. If sovereign states step in to unconditionally backstop the war risk insurance, or if the maritime underwriters simply reprice the premiums to a level the market decides to absorb, the tankers will pull up their anchors. They will sail. The immediate supply shock evaporates, pulling the geopolitical panic premium out of the oil price instantly. Do not underestimate the entities on the other side of this trade. Western banks possess the historical precedent and the structural mechanics to force paper market slams on geopolitical opens. This is not a conspiracy. It is a documented tactic. They use the liquidity vacuum to flood the screen with synthetic supply. Physical premiums compress if paper markets slam lower Monday. The banks have coordinated this exact maneuver during geopolitical events before. They smash the paper price to break the psychology of the physical buyer and force a technical reset. That is the structural risk. You are not just trading against a geopolitical timeline. You are trading against an entrenched financial architecture engineered to maintain the illusion of paper control. If the paper price is hammered down in the open, the arbitrage window slams shut. The $120 physical bids in Shenzhen could be left stranded as the paper derivative forces the physical market to briefly bend. The thesis is mathematically sound, but the mechanics of the Western Open are utterly ruthless. Capital is not reacting. It is violently reacting. The shift is out of paper derivatives and into absolute unforeseeable necessities. Discard retail sentiment entirely. The mainstream will spend the next week debating inflation metrics and central bank policy responses. They are completely lost. 3 assets matter right now: gold, silver, and oil. That is the entire board. Gold is your monetary reset hedge. Silver is your industrial shortage play. Oil is the ultimate truth, because energy cannot be printed. Look at your screen. Everything else trades on sentiment. Tech stocks, real estate, sovereign bonds, they all require a functioning system, undisturbed supply chains, and absolute counterparty faith. These 3 assets trade on strict, mathematical necessity. When the risk architecture collapses, necessity is the only metric that clears the market. You either have the metal and the energy, or you do not. The informed minority knows exactly what to look for. When Western markets finally open, do not watch the talking heads. Track the defined variables. Watch the exact gap size on gold and silver futures. That gap is the paper market bleeding into physical reality. Monitor the Shanghai premium. Watch closely if it widens past that $27 mark, or if the Western banks manage to force a compression. Track the strike duration. Are these kinetic events dragging out for days, or does the assault pause? Watch whether the Strait of Hormuz closures expand or stabilize. These are the only structural metrics that dictate the real tape. The divergence is absolute, and the math favors the physical holder. Understand the psychology of the Eastern physical market. Physical buyers in Asia paying $120 for silver are not selling at a loss just because Western banks want lower prices. They are not day trading a COMEX contract. They are securing industrial survival. If a Western institution slams the paper price down on the open, the Shenzhen recycler holding physical ounces at $120 does not panic sell. They buy more. The suppression becomes a direct subsidy for the physical accumulator. The paper illusion inevitably shatters against the wall of physical possession. This is the identifiable process. You either read the raw data, or you become the exit liquidity for the institutions that do. Do not let momentum chasers dictate your conviction. This is not financial advice. This is financial warfare education. Protect your capital. Invest with logic, not hype.